Ever looked at a company's financials and just felt your eyes glaze over? Well, today, we're going to change that. We're demystifying one of the most powerful tools in business, the balance sheet. In just the next 2 minutes, you'll learn how to read it like a pro and really uncover the story it tells about a company's health and its strategy.
So let's start with the most important idea right off the bat. A balance sheet is not a movie of how a company's doing over a year. Nope. Think of it as a single, powerful photograph. It literally freezes the business on one specific day, like December 31st, and gives us this crystal clear picture of where things stand at that exact moment in time.
So, what's this photo actually showing us? Well, it's a really fundamental story. It's the ultimate statement of what a company owns versus what it owes. On one side of the scale, you have all the valuable stuff the company controls, its assets. And on the other, you see who has a claim to all that stuff, either the lenders or the owners themselves.
Okay, so let's dive into how this all works. The entire balance sheet, I don't care how big or complicated the company is, it's all built on one simple, totally unbreakable rule that always holds true.
And here it is, the fundamental accounting equation. It's just common sense when you really think about it. Everything a company owns, all its assets, had to be paid for somehow, right? And the money could only have come from two places. It was either borrowed from someone else, those are the liabilities, or it was put in by the owners, that's the shareholders' equity. That's it. That's why the two sides always have to balance. Here's a really fantastic way to think about it. Uses versus sources. On the left side, the assets show you how the company uses its money to run the business and grow. And on the right, the liabilities and equity show you the sources of that money. Where it all came from in the first place. Simple as that.
To make this really stick, let's bring it home. Literally. Let's just think about buying a house for a second.
First up, you've got the house itself. Its total value, let's say it's $400,000. Well, that's your asset. It's the valuable thing you now get to control. But, most of us don't have that kind of cash just lying around, right? So you get a mortgage from the bank for $300,000. That loan, that's your liability. It's what you owe to someone else. It's the bank's claim on your asset. And finally, that $100,000 you scraped together from your savings for the down payment, that's your equity. That's the part of the house you truly own. And just like that, the whole equation clicks into place. Your $400,000 asset is perfectly balanced by a $300,000 liability plus your $100,000 in equity. See? It works. All right, now that we've got the big picture, let's start peeling back the layers of that equation. We'll start with the assets. What kind of stuff does a company actually own and use to make money? So assets basically come in two main flavors. First, you've got current assets. Think of these as the short-term stuff, like cash and inventory, the resources a company is going to use up within about a year to keep the daily operations humming. Then you've got your non-current assets. These are the big-ticket, long-term items, like buildings, machinery, and patents that are going to provide value for years and years. Okay, so that's what the company owns. Now let's flip over to the other side of the equation. Who has a claim on all those assets? Where did the money come from to pay for all that stuff? And again, it's pretty simple. The funding for all those assets comes from just two places. First, liabilities. This is money from outsiders, like loans from a bank or bills you owe to your suppliers. Bottom line, it's what the company owes. Then you have shareholders' equity. This is the owner's stake in the company, their initial investment, plus all the profits that have been plowed back into the business. This is what's truly owned. And this equity part is so important. The best way to think about it is as the company's financial cushion, its risk buffer. A company that has a lot of equity is just in a much better position to survive the tough times because it has less debt it's forced to pay back. It gives them stability and a lot more flexibility. So, we understand the pieces now. Assets, liabilities, equity. But so what? How do we actually read this snapshot to judge a company's health? How do we turn all these numbers into actual insights? This is probably one of the most critical, immediate questions a balance sheet can answer for you. It all comes down to a concept called liquidity. Basically, does the company have enough cash or things it can turn into cash quickly to cover all of its upcoming bills? And a really key metric for this is the current ratio. It's a super simple calculation. You just divide the current assets by the current liabilities. A healthy sign is often a ratio around 2 to 1. That means the company has $2 of short-term resources for every $1 of bills coming due soon. That gives you a nice, comfortable safety margin. And this brings us to a really critical distinction. Liquidity is all about short-term survival. Can you make payroll this month? Solvency, on the other hand, is about long-term stability. Do your total assets outweigh your total debts over time? And here's the kicker. A company can be perfectly solvent, with tons of valuable long-term assets, but still go bankrupt if it's not liquid and simply runs out of cash to pay its immediate bills. So let's wrap this all up. If you remember just 3 things from this explainer, make it these. First, the balance sheet is a financial snapshot, not a movie. It's a single point in time. Second, that unbreakable equation, assets equals liabilities plus equity, it always holds true. And third, you can use super simple ratios to start reading that snapshot and get a real feel for a company's financial health. And I'll leave you with a final thought here. A balance sheet is way more than just numbers. It's a direct reflection of a company's strategy. So next time you're looking at a company you like, think about its balance sheet. Is it funding its growth with a mountain of debt or with its own profits? Is it built for the long haul or is it taking on huge risks? That single snapshot can tell you a whole lot about the choices it's making.